Intel stock, ticker symbol INTC, is one of the worst performing stocks in the S&P 500, being down 26% in the past year and down 61% in the past 5 years. Moreover, if we compare it to its competition, as you can see, in the past 3 years, Nvidia is up 872%, Broadcom is up 435%, Taiwan Semiconductor up 162%, and Intel down 40%. So it's not a problem of the industry. In this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, some statistics, as well as using my Google Sheet to calculate the intrinsic value of the company. But first, let's see why the stock is down these years, which is mainly because of these 4 reasons that I have summarized here. So number 1 is rising competition, mainly to AMD and Nvidia. Number 2, costly and poorly timed turnaround attempts. Intel has been waiting for a turnaround in the past year, but it doesn't seem like it's coming anytime soon. Number 3, layoffs and deep restructuring, which include reducing headcount up by 20%. And number 4, macro headwinds and regulatory challenges, mainly the tariffs with China and the expiration of certain subsidies like the CHIPS Act. So Intel does not longer have government support. So let's start with the financials. As you can see, the revenue of this company has decreased massively in the past years, with the stock doing $78 billion in revenue a couple of years ago, and right now Intel is doing around $53 billion. Now the revenue seems like it's no longer decreasing, but also not increasing. Then if we take a look at their profit, you're going to see that net income, for example, used to be positive at around $23 billion a couple of years ago and is currently negative $20 billion. We're going to see the same with free cash flow, used to be positive and is currently now negative. Now, this is because they're trying to reinvest all their money into growing the company and trying to turn things around. And this is also why their margins, logically, are also negative. They used to have a profit margin between 20 and 30%, and the same with free cash flow, and is currently down to negative 24%. This is also what they had to cancel their dividend. And one last thing that I will mention about the financials is the number of shares outstanding, which has been increasing massively over the past years. Why? Because again, they are trying to raise money. Now, this is negative for investors because you're owning less of the company, basically by doing nothing. Now, if we take a look at what's expected for the future of this company, revenue is expected to grow, but very little, reaching $57 billion in a couple of years. However, EPS is expected to recover nicely and reach $1.40 per share in 2027. And there are a lot of analysts covering this stock. Now, if we take a look at some statistics, we're going to see the balance sheet. So they have $21 billion in cash and $50 billion in debt. Now, this is some debt and something that we have to consider, but this is still a very big company, so I don't think they're going to go bankrupt anytime soon. Now, if we take a look at some valuation ratios, the P is not available, the price to free cash flow is not available. Why? Because net income and free cash flow are currently negative, and the price to sales, it's 1.85. Now, this is quite cheap compared to its competition, like Nvidia or AMD or Taiwan Semiconductor, but it's cheap for a reason. And in order to take a deeper look at the valuation, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. All the calculations are done here, so you only need to move these numbers around. As you can see, according to my assumptions, the intrinsic value is between $19 per share and $62 per share, and the stock is currently trading at $22 per share. This also means that if my low assumptions occur, you're going to make a 7% annual return on your money, middle 20%, and high 31%. So huge returns according to my middle and high assumptions. Now, what's the problem here? My assumptions are based on past results. because I believe that if you decide to invest in Intel, you need to believe that this turnaround is going to happen. This is why for revenue, I did 3, 6, and 9% for the next 7 years. Profit margin and free cash flow margin, although it is currently negative, I did positive 10, 15, and 20%. I assigned a P/E and price to free cash flow at the end of the 7 years of 16, 18, and 20, and left the share outstanding change at 0%, even though it has been increasing. So as you can see, my assumptions are very ambitious. And if you want to get access to the spreadsheet, send me an email to the one I have left in the description. In conclusion, I believe that if the turnaround happens for Intel, you're going to make huge returns in the future. However, things are not looking very good, and I am personally waiting for a couple of quarters in order to invest in this company if things go right. I hope you found this video valuable. Let me know what you think about Intel stock in the comments, and I'll see you in the next one.